So I'm wondering, what does the latest increase tell us about how the Fed's battle to tamp down inflation is going?
Sure, but let me clarify something first. Like the federal funds rate is not the rate that consumers pay for their loans. So this is the rate at which like banks borrow and lend to one another. But while this is not the rate that consumers pay, a higher rate for banks tends to make like borrowing more expensive for consumers, eventually like affecting long-term interest rates and mortgage rates as well, such as like the 10-year Treasury yield. So the Federal Reserve rates interest rates like yesterday. However, there weren't any big surprises from the Fed with the recent rate increase matching investors' expectations. And what we see as a result, the 10-year Treasury yield dipped below 3.4% yesterday. So we should have in mind that the markets are usually driven by investors' expectations. For example, investors don't wait to react until the last minute, until the moment that the Federal Reserve raises rates. When they expect this move from the Fed, they react before and they don't wait until this happens. And we saw that like both the 10-year Treasury yield and mortgage rates fell this week, demonstrating that the market had likely already priced in the recent rate hike by the Fed, and that's the reason we didn't see any spikes for these rates this week. So with this additional rate hike, inflation we expect to slow down even further in the following months.
And we know that it's likely that more rate hikes will come, but that's not spooking investors at this point?
No, because we already know that. On the other hand, I don't think there will be rate hikes for the whole year. So I expect about 2 additional rate hikes. And we have seen the Federal Reserve to switch already to smaller rate hikes. And this is very good news for investors.